In 2026, you can do everything right and still be denied access to money in seconds. You can have an excellent credit score, a stable job, years of experience, and a spotless payment history, and none of it guarantees approval anymore. Your loan application can disappear without a word. No phone call, no interview, no explanation. Not because a banker reviewed your file. Not because a committee debated your risk, but because an algorithm calculated that your future contains too much uncertainty. This is the part most people struggle to accept. Money is no longer approved by humans. It is forecast by machines. For decades, people believed money followed effort. Work harder, stay disciplined, build credit, increase income, make smart decisions. That belief matched the system that existed at the time. Banks were human institutions. Files were reviewed manually. Judgment mattered. Exceptions were possible. Someone could look beyond imperfect data and recognize reliability. That human layer created flexibility. It allowed context. It allowed negotiation. It allowed second chances. That layer is fading, not dramatically, not publicly, but structurally and permanently. There was no announcement when the shift occurred, no global alert, no headline declaring that financial authority had transitioned to algorithms. The change happened incrementally. Artificial intelligence first reduced fraud, then optimized advertising, then accelerated trading, then refined risk modeling. Each step improved efficiency, each step reduced cost. By the mid-2020s, AI systems were outperforming humans in short-term predictive finance tasks. Hedge funds deployed autonomous models capable of reallocating billions in milliseconds. Banks adopted similar systems. Gradually, the technology that predicted markets began predicting individuals. Traditional credit systems were backward-looking. They asked, did you pay on time? How much debt do you carry? How long is your credit history? These models used limited variables and linear logic. Artificial intelligence operates differently. It treats your financial history as training data for forecasting future behavior. The central question is no longer whether you repaid yesterday. It is whether you remain stable tomorrow under stress. Modern financial models evaluate thousands, sometimes tens of thousands, of behavioral data points per person. Income consistency, deposit timing, spending volatility, saving slope, liquidity buffers, subscription churn, expense drift, transaction cadence. Individually, these signals mean little. Combined, they create a probability model. You never see this composite score. Institutions do. In 2026, capital is allocated based on projected stability. Two individuals earning identical salaries with similar credit scores can receive entirely different outcomes. One qualifies instantly at a favorable rate. The other is classified as elevated forward volatility risk and receives stricter terms, or a denial. There is no anger in that decision, no personal judgment. The system minimizes uncertainty because uncertainty carries cost. Look at the broader market for proof. The majority of U.S. equity trades are executed algorithmically. High-frequency systems scan earnings data in milliseconds, detect sentiment shifts instantly, and execute in microseconds. Retail investors are not primarily competing against other people. They operate inside environments shaped by machine learning models trained on decades of behavioral data. That same predictive precision now evaluates personal finance. In 2026, lenders do not simply review whether a business is profitable today. They simulate potential futures. Revenue streams are stress-tested. Customer concentration risk is measured. Supply chain exposure is modeled. Downturn scenarios are calculated in seconds. If resilience appears strong under stress, capital expands. If vulnerability rises in simulations, funding tightens. Probability determines access. Employment operates under similar logic. AI-driven hiring platforms assess projected long-term contribution, retention probability, productivity acceleration, and burnout risk. Two resumes that appear identical to a human reviewer can generate different long-term value forecasts. Compensation and advancement increasingly align with projected trajectory rather than past achievement alone. Most people believe they are evaluated solely on visible accomplishments. Increasingly, they are assessed on predicted behavior. Artificial intelligence does not only restrict capital, it also increases it. Profiles demonstrating stable deposits, steady savings growth, controlled spending variance, and rising income durability may receive automatic credit limit increases or preferred financial offers before any request is submitted. From the outside, it feels earned in the moment. From the system's perspective, the approval was mathematically justified long before. Money in 2026 follows data alignment. Impulse spending spikes are categorized as volatility. Income gaps elevate modeled risk. Irregular financial patterns increase predictive uncertainty. Even flawless repayment may not offset instability under stress simulations. In this environment, the most advantaged individuals are not necessarily the most aggressive. They are the most consistent. Smooth income growth, controlled leverage, strong liquidity reserves, measured long-term behavior. Artificial intelligence rewards durable curves and discounts chaotic spikes. Governments apply similar models. Predictive systems reduce fraud losses. Flag tax anomalies in real time. Assist in directing economic support based on vulnerability metrics. During downturn modeling, sectors are prioritized based on stabilization efficiency. The framework becomes increasingly mathematical. This introduces a difficult question. If an algorithm predicts elevated default probability during a recession, should pricing adjust before the recession arrives? From a capital preservation standpoint, the answer is straightforward. From a human standpoint, it is complicated. Finance operates on risk-adjusted return. Some attempt to manipulate signals, temporarily lowering utilization or boosting visible liquidity before applications. Advanced systems monitor for abrupt behavioral shifts. Sudden pattern changes near financial events trigger anomaly detection models trained on historical gaming attempts. Short-term adjustments rarely outperform long-term alignment. Wealth strategy now includes signal stability. Consistency outperforms intensity. Long-term trajectory outperforms short-term bursts. Income durability matters. Savings resilience matters. Behavioral reliability matters. Behind the scenes, multi-year financial reliability projections influence pricing tiers, insurance premiums, credit ceilings, and investment access. This is not theoretical. AI systems manage trillions of dollars globally. Autonomous platforms rebalance portfolios daily. Underwriting decisions occur in seconds. Insurance premiums adjust dynamically based on behavioral risk scoring. The difference today is integration. Artificial intelligence does not merely assist financial decisions, it executes them. At this moment, your spending patterns, saving slope, and income stability are forming a forward projection. That projection influences whether institutions classify you as a low volatility asset or an elevated exposure. In 2026, artificial intelligence decides who gets money, not based on promises, not based on intention, based on modeled probability. The future of finance is predictive allocation. Whether that future feels efficient or dangerous depends on one thing. Are your patterns aligned with stability and growth, or are they signaling risk? If this changed how you see modern finance, take a second to like the video so more people understand what's happening beneath the surface. Share it with someone who still believes financial systems operate exactly as they did 10 years ago. Subscribe for deeper breakdowns on how AI is reshaping capital, opportunity, and power. And in the comments, tell me your view. Does algorithmic money allocation make the system smarter or more fragile? Let's discuss it.